summer night. Storm clouds in the air. My eyes a little heavy. I'm feeling in the past and I'm hardly aware.
Hey everybody, welcome to the Lund Loop Daily Update for Thursday, July 30th, 2026. Just watching some initial Amazon rippage and after hours. So this is normally the time where I walk you through the intraday action in the indexes, give you a little bit of color there. But I actually want to, before I do that, I want to talk about this last 24 hours because it's been very, not only interesting, I always say it's interesting, but it's been very instructive. So yesterday I was on a Spaces before the market closed, and yesterday was a pretty bearish day in the market. A lot of people were asking, what's the catalyst for a bounce? What can we have happen that will give us that bounce and hopefully a sustained bounce? And a lot of things were bandied about, people talking about geopolitical things. Something has to happen in Iran. The FOMC has to do something. There has to be a change in the approach to CapEx, lots of different things. And it's not that I disagreed with those things, but what I said needs to happen for a bounce, and certainly for a sustainable bounce, is we need some market mechanics to kick in. We need a leverage product to blow up. We need a hedge fund to blow up. Why? Those events don't cause the reaction. They're a result of the action. Those things usually happen at the extremes. So when we see them happen, they're not going to then cause the market to rally. They're happening because we know we're near those extremes. And so after hours, we had Microsoft and Meta come out. Meta not so good, but Microsoft was interesting. They were a little more dovish on their CapEx spend, and they started to ramp a bit. Then this morning, the news came out that the wonderkind Leopold from Situational Awareness blew up his fund. At some point, the reports were that it was a $50 billion fund, blew up and sold the holdings to Citadel for $10 billion or less. And what happened? The market just continued to ramp all day. So that is that structural event I was hoping to see. Does that mean the bottom's in? Not necessarily, but it means that we have a better chance, I think, now for a sustainable move. And we'll talk about how we'll play that in a minute when we get to the watch list. But I think this whole Leopold thing is so instructional here. One of the things we focused on so much the last few weeks is talking about risk and how we approach risk. I want to give an example, and I want to illustrate it with a story. I've told this story to subscribers before. This was back in early January of 2025. And I had a buddy of mine, a guy who I'd known since second grade, called me up and said, hey, my son has been trading crypto for the last couple of years, and he's done pretty good. He's turned $20,000 into $250,000. But I think he's at the spot where he really needs to talk to someone that knows what they're doing and maybe can show him a different perspective and maybe show him where the next phase of this trading journey is going to go. Sure, no problem, I said. Let's get on a call. So got on a call with his son. I know his son, good kid, smart kid, polite, respectful kid. We had a really good call. We talked about a lot of different things. But at one point I said to him, let me ask you something. So you're doing this crypto trading. What's your goal? Why are you doing this? And like I said, he's a polite kid. He's a respectful kid. But at that point, he answered in a way that was kind of like saying, no, duh, to me. He said, well, I'm doing this to make money. And I said, okay. How much money do you want to make? And he's, again, kind of answered me a little bit like, why is this old guy asking me this question? And he said, I want to make as much money as I can. And I said, okay. And then I asked him, how much risk are you willing to take to make that money? And that kind of stopped him a little bit. And what I explained to him is I said, look, my goal is the exact same as your goal. I want to make as much money as I can. You want to make as much money as you can. Pretty much everybody that's in the market wants to make as much money as they can. The difference is everybody has different risk profiles, and those risk profiles are the limiter on how much money you can make. So for example, he's a young guy, 22, 23, no kids, no wife, no mortgage, plenty of time ahead of him if he blows up. Maybe for him, let's take a $100,000 account across 5 different people. Maybe for him, as much money as he can in a year, maybe that's turning it to $500,000, right? And he can do that because he doesn't really worry about risk. Now, there might be someone at the other end of the scale. Maybe they're 65 and they're retired and they like to trade, but they take a lot more risk-averse approach to the market. That extra risk aversion means that maybe they can only just beat the S&P, right? Or maybe they can double their account. And everybody has to find a spot along that continuum, because the idea that you're going to take no risk and let's say 5x or 10x your account is ridiculous. I think one of the problems that traders have, and I'm going to date myself by saying this, but back in the 80s, everybody that was into trading was into the movie Wall Street. And so they go watch the movie Wall Street and they would see this slash and burn type trading, Gordon Gekko, guy making millions and millions of dollars. And they'd go, that's what I want to do. That's who they related to, right? So they go into the market with that attitude. That's the projection of who they think they are in the market. The problem is that usually didn't line up with their emotional, mental, psychological state. Those states were much more risk averse than that projection that they had. So they go into the market trading in that swashbuckler way, that Gordon Gekko way, but internally that tuning fork does not true up. So they start to self-sabotage. They start to do things that undermine what they're trying to achieve, and they don't even know it because different parts of their psychology are just clashing with each other. This is why I tell people you should go to therapy, because in therapy, you learn how to be a little bit introspective, how to line these things up. I think this is also why a lot of people outsource their risk parameters and their stock selection to others, because doing that work you have to do to get yourself trued up and figure out what you think here and what you think here, it's hard work, right? It's tough work. It's easy to outsource it to a newsletter. It's easy to outsource it to a guru. It's easy to outsource it to a pick service. The problem is when you do that, you have no control over what happens. You have no agency. And I saw that the last couple weeks writ large. People talking about names that they were holding on to that were down 30, 40, 50, 60, 70% because, Leopold bought them. This guy's super smart. He's a wonderkind. He's doing this $50 billion fund. He's from Anthropic. I mean, if Leopold is holding XYZ, it's got to be a good stock. So they invested all of their risk parameters and all of their stock picking in some guru type guy. So this morning, when it turns out that this guru had to offload his portfolio in a fire sale to Citadel, their whole world exploded. Everything that they structured their trading and their risk parameters on, that belief that Leopold knew what he was doing, just went away. And a lot of people were freaked out. And you know what they started to do? They started to pivot to the next guru. Well, if Citadel bought their positions, then they must be bullish on all these names. And that's probably a reason for me to hold them, right? The point I'm trying to make here is when you do the work that you need to do to really figure out where your risk parameters are, how much money do you want to make in relation to the risk you're worth taking? When you true that up, then you now have control of your destiny. You are not you're not subject to the whims of this newsletter writer or this guru or this pick service. You can have confidence that you're doing things that align with your mental, your emotional, your psychological state. You can do things that make sure you sleep well at night. You can do things that make sure you don't fight with your spouses, that you're not aggravated all the time, because you know why you're in positions, you know where you're willing to get out, you know what risk parameters you're taking, and trust me, it is a much, much better way of approaching the markets. All right, so having said that, let's go look at what the markets did do today, because it was actually pretty good. I liked seeing this. All right, so let's look at the intraday action here. So we got this initial gap up in the SPX. And one of the things that I always do when we have a gap up, and especially if it's news driven, is I say, let's wait until we get to about the 8:30-ish time frame, Pacific Coast time, because that usually gives us enough time to see if the move is sustainable. So we initially ramp like this. It looked like we're in a double top here. We started to sell off, and right about the 8:30-ish point, right there, that's where we found the ultimate bottom, which was actually near the opening range. And then we started to ramp, and what happened? We recaptured the 5, the 9, the 20, and then, as often happens in these situations, the 20 became support, and we had a trend up day that closed pretty near the highs. Now, we did not get back above yesterday's high on the SPX. However, what we did do is we got above it on the Qs. In fact, if you look at all the indexes here, when the green line is the highs from the previous day, we didn't get up there on the IWM. We were a long way from it on the Dow, fairly close to it on the SPX. But the most important thing is that we got way above it on the Qs. And the reason I say that's the most important is because the Qs have been the weakest on a relative basis lately. And this flip around, this is where all those stocks were getting sold bad, right? All those AI stocks, all those chip stocks, those memory stocks, all those Leopold stocks. This again augurs, I'm going to use the word augur, towards a potential short-term bottom in place. Let's just see what Amazon's doing. And Amazon's helping out here, which is great. We got the FOMC in the rear mirror. We had GDP today. We had PCE today. We get Amazon out of the way. We get some of these big names out of the way. We might have a glide path. Tomorrow's the last day of the month. So a lot of things are setting up to say that this could be a short-term bottom at least. Now, how do we know if this is a short-term bottom opposed just to a counter trend rally? Well, if you've been a Lund Loop subscriber for any amount of time, you know there is a set of criteria. And each piece of criteria, as it stacks up, gives us more confidence that, yes, that was a bottom. But it's not just one and done. It is a process that builds upon each other. And you all know what the first step in the process is. I've said it a billion times.